Well, good afternoon, everyone, and welcome back. Once again, we're back with KoreSummit Day 2, Real Estate, the Jobs Act, and Liquidity. This afternoon, the conversation is going to get very, very fun. We have some great speakers coming up, led with Peter Daneyko and his fellow colleagues. They're going to be discussing fractionalization in real estate and everything that has to deal with it. So, Peter, the floor is yours. Enjoy.
Hey, thanks, Oscar. Are we on here? First
Well,
off, hey,
I believe we are. I don't think your camera's on, but that's okay. I'll come in and, of course, the technical difficulty needed to happen sooner or later. So something must have happened there. All right. So yes, we are on. Turn on your camera there, Mr. Daneyko. Probably
we're
got too many buttons to play with.
we're going to turn this on again. Everybody, just bear with us for 1 second as we jump into the session. The camera was on, and we're going to get back on track here.
All right. Get going.
All right. Hey, I'd like to welcome our audience, and I'd especially like to welcome this, what I believe an extremely engaging panel. So, first, a couple of quick introductions here so everybody has a bit of color on who's who from our panel. So, we've got Tyler Harttraft from partner in blockchain law. So, blockchain law, a very specific category that we're going to be talking about, and speaker, author, member of the Blockchain Association. And Tyler's firm is dedicated to cutting edge smart contracts, which we're going to touch on, in blockchain technology. Welcome, Tyler. I want to introduce Laura Pamatian, CEO of Height Zero Real Estate, one of the oldest advisory firms in the blockchain space focused on real estate, and a focus on leveraging and modernizing artificial intelligence and blockchain technology and everything that relates to real estate, and quarterbacks lots of companies in this regard. And last but certainly not least, from the broker-dealer side of the equation, I'd like to welcome aboard Richard Johnson, CEO of Texture Capital, one of the few companies actually licensed by FINRA as a broker-dealer of digital asset securities. So certainly on the cutting edge of things, as well as Texture operates a fully registered SEC alternative trading system. We're going to touch on that to match investors and buyers and sellers. So everybody, welcome aboard. Jumping in, the term we're talking about today is tokenization, fractionalization. A lot of these so-called buzzwords. Hopefully, we can give them some color and some clarity today. My experience over the last few years is pretty much I get comments daily from clients such as, "Can I tokenize this?" Well, we live in a permission blockchain environment at KoreConnex. So kind of everything we do is a little bit about tokenization, but first and foremost, it's about the regulations and compliance. And depending on the regulations and the securities being offered, I think we'll jump into the narrative and the conversation on what is that all about. And I'm going to jump over to Tyler right away from the legal perspective. Tyler, from the legal side of things, we hear the term token chain, blockchain, tokens. It's all on the news. Give me your definition of tokenization and how that relates to a security, because it's certainly with the FTX fiasco and the ICO world, those are two different worlds. And maybe you can give us your legal insight on that.
Yeah, absolutely. I mean, to your point, there's not very much that can't be tokenized, but that doesn't necessarily you have something that should be tokenized. And so there's a lot of layers to peel back as far as tokenization and exactly what we're speaking about. We're usually referring to trying to determine what the underlying asset is. So, in the FTX scenario, an FTT token might represent ownership to a particular indebtedness. And so that would be a token that represents one underlying asset, whereas a security token might represent an equity stake in a company, a share of stock, an LL, a limited partnership interest, a limited liability company interest. And so when we're working with clients, that is the first order of business with respect to digital securities issues, identifying the underlying asset that will be tokenized and then looking to determine should we tokenize that? Why do we want to tokenize that? Obviously, there's a lot of benefits to tokenization, mainly liquidity, or the anticipation that there will be liquidity for a particular asset once the lockup restrictions have been lifted. But there are a lot of considerations that come into play. There's a lot of regulations to be aware of, and that's what we're here to work through clients with. Just because we have a token doesn't mean the securities laws go out the window. Doesn't mean that tax laws go out the window. Additionally, there's Investment Company Act regulations. There's Investment Advisor Act regulations that clients need to be aware of. And so all of these regulatory frameworks play into the analysis and must be considered with respect to tokenization, because we're really talking about a technology overlay, not necessarily something that can skirt the securities laws. In some circumstances, a token does represent something that is potentially other than a security, potentially not an investment contract. So lots of token issuers out there that are generating tokens as a means of governance, a means of an economic incentive for a particular protocol or ecosystem or layer solution. And so in that context, you might have a token that maybe it's sold as a security initially for capital raising purposes. Maybe it's supposed to eventually represent a governance token and not necessarily a receipt to profits or any earnings of the issuer. And in that circumstance, the question becomes very muddy as far as, is this security, is this not? And so, like I said, a lot of layers.
Okay, a lot of layers. You hit a lot of points, which you touched on regulation, you touched on assets, you touched on liquidity. So let's dive in a little deeper when it comes to real estate in particular. Laura, your experience from a real estate perspective, you've been involved in the real estate market for a significant part of your life. You've jumped into this whole concept, and we've had lots of conversations about, hey, I want to tokenize this particular real estate. What are some of the key conversations that you've had, and maybe some of the friction points or misunderstandings around real estate and tokenization?
Yeah, thanks, Peter. And I think that, with tokenization, we say that word and there's different people that will think different things, right? So tokenization of real estate in the aspect of creating a non-fungible token to transfer real estate assets, right, in their entirety. So that would be one form or one interpretation of that. Another is to tokenize existing equity, right? The asset has equity, and we're able to create the option of liquidity by tokenizing shares of that equity. Then also through raising capital, right, which is a whole nother ballgame. And like we keep saying, the securities law, the framework that's in place is adequate, right, for raising capital and then tokenizing that security, right? I think people say security tokens and tokenized securities and don't realize that there's a difference. So I think there's an issue there as well.
Can you elaborate on that a little bit? You said security tokens and tokenized securities. Whether you or somebody wants to weigh in on that a little bit.
Yeah, so when we say security tokens, we refer a lot of times to tokenized securities when we're talking about real estate. But when in other aspects of the space, a security token could be your access to, say, my bank account, right? I have a security token that gives me access to my bank account. It's in the terms of safety, right? Security in the terms of safety, rather than a security, right? A financial security, which is tokenized securities. So
okay. So there's again a lot of definition that revolves around the concept of tokens and the concept of tokenization. So let me ask Richard from this perspective. So as a broker dealer, and when it comes to tokenized securities, what are you seeing today specific to the real estate? And do you begin with the asset being the real estate or the project you're going after, or do you begin with the regulations, or do you begin with who are you trying to sell it to, or do you begin with the corporate structure? There's a lot of pieces there, and where do you begin, and what's your experience on that?
Yeah, thank you, Peter. I just want to kind of touch back on to something that Tyler was talking about, where, in the realm of tokenization, there's lots of different tokens out there, DAO tokens, and NFTs, and so forth. The thing about real estate, when it comes to real estate tokenization, unless you're talking about putting the actual title on blockchain, pretty much everything is going to be a security of some kind. So that's, that cleans up some of the confusion, I hope, because it meets the 4 prongs of the Howey test. It's an investment of money based on the efforts of others with an expectation of profit, etc. And I think that's what people are used to when they're investing in real estate. Is they see the term sheets, they have a pref return of this and the investment of that and so forth. And what we're doing, in the tokenization space is essentially kind of replicating that in token form. So we kind of mirror a lot of the PDF documents that we're used to seeing, put that into a token form, put it on the blockchain. And I think one of the big advantages you get from that is, first of all, a lot more transparency. The thing about real estate is it's a very large market, but it's not very transparent necessarily. So we can improve that there. It's also typically not very liquid. A lot of, fund structures are normally 5 to 7 years, and some real estate projects can last longer than that. So what we aim to do as a broker-dealer is help provide liquidity for these types of projects. And we're able to do that by leveraging blockchain technology. So we employ, first of all, we have a complete record of securities ownership and transaction history, and we can employ smart contracts to programmatically enforce compliant rules such as a 1-year holding period if it's a Reg D offering, maximum number of shareholders, which could be 99 if it's an LLC, or it could be 2,000 if it's a C corp, and so forth. And then, by having this kind of digital layer and these programmatic smart contracts, we're really able to kind of improve the workflow, streamline liquidity onto our ATS, and enable secondary trading. You're asking kind of what we're, how do we approach the space? For us as a broker dealer, we're here to serve our clients. So we look at different structures, and normally the client comes to us with a framework in mind, and we'll kind of advise them and consult with them and help them bring that to market.
You touched on something that comes back to the regulations again. You said a Reg D, and you said there's a 12-month holding period. Let's start with the regulations a little bit, and where they fit in or don't fit in, or where some of the friction points might be. So I'm an existing, and I'm going to point this to Tyler and then to Laura. So I'm an existing shareholder, and I invested in a Reg D. My understanding from the Reg D perspective is the information associated with what my rights are as an investor in that Reg D are varied as every individual company. So after this 12-month window, it doesn't just arbitrarily gives me this ability to have a liquidity event. Would that be correct? Or maybe you can give me some more insight into that from a legal perspective.
Sure, Peter. Yeah. So the Reg D regulation has a 506C is one flavor, and then 506B is another. Generally, we're talking about 506C, which is what most capital is raised under, because that allows you to generally solicit investors. With a 506B, you can accept up to 35 non-accredited investors, but it doesn't allow you to advertise, so it's much less useful for most capital raisers, especially in the real estate context. So with respect to 506C, you can raise an unlimited amount of money from accredited investors, generally solicit, and your lockup restriction under Reg D is going to be 12 months. There's an opportunity to trade that accredited investor to accredited investor more quickly under Rule 4A7, the FAST Act, but there are some additional requirements to be met. But generally, when we're talking about the liquidity event, we're talking about the expiration of that 12-month lockup and a sale from the primary purchaser to a secondary purchaser. And so with many of these solutions and exchanges that are coming online, they're offering that opportunity, that marketplace for those primary purchasers and secondary purchasers to transact.
Okay, so you mentioned and we'll focus a bit on the Reg D. So I hear that a lot. And Laura, we've had conversations about when it comes to a Reg D, Okay, after 12 months, I can trade. Let's make the assumption that all the articles associated with that Reg D is equitable and everybody can trade those shares. But where do I trade them? Maybe this is focused more on Richard because you're on the ATS side of it. So where do I trade them, and what does that look like, and what are my limitations under the different regulations? So I've got, we're going to talk about a 506C and a Reg D right now.
Yeah, well, it's a regulatory requirement to trade them, to trade securities. Well, you can trade them kind of. There's a few kind of exemptions within the real estate space where members of an LLC can trade membership interests between them. But if you want to reach a broader market, you generally need to go through an ATS, which is operated by a regulated broker-dealer such as Texas Capital. We're regulated by FINRA. We have an ATS, which stands for Alternative Trading System. It's actually the Reg ATS, which kind of gave birth to ATS is as part of the Exchange Act. So an ATS is similar to exchange, but it's a lower threshold to qualify for it. So yeah, that's our goal at Texture and many others in the space, is to provide liquidity on the platform, matching so that people who purchase these securities in the primary offering, if they want to have some liquidity, if they want to sell the security after a period of time, then they can find other potential buyers and sell to them on our platform. And I think we find a general advantage. What we often hear from folks is that, certainly from issuers, even if it's a Reg D and even if there's not going to be any liquidity for a year, the issuer likes to be able to say that because it helps them get primary investments. So for example, they might have an investor who wants to invest, but their kids are going to college in a few years, or something like that, or maybe there's a life event and they want to be able to have some kind of liquidity option in case in the event that something comes up. So we're able to provide that for a lot of these firms.
Okay. So what I'm hearing is then the liquidity side of it, I can put my shares up from a layman's perspective. I invested in a Reg D. I'm an accredited investor, and I can sell them to other accredited investors, or at least make them available. Now, who makes that decision? Is it the company making the decision, or can I just randomly say, hey, I own some shares? So maybe walk us through that process a little bit, whether it's a Reg D or Reg A or Reg CF for that matter.
Yeah, in private markets, I'll jump in here. In private markets, typically the issuer or the GP or whatever the structure is would need to approve any secondary transactions. So you can't just have trades necessarily going off without their consent. The issuer, generally speaking, needs to be involved. If it's a registered offering, that's not the case. I don't know if anyone else wants to chime in on that.
Yeah, and I mean, typically, platforms that are allowing these trades, they want a legal opinion stating that, okay, the securities have seasoned, the lockup restriction no longer applies, and now these particular investors who have held since their purchase date more than 12 months ago can now trade legally on the platform. And so that's one of the items that we assist with, is rendering that opinion at 12 months after the purchase date for each of those investors. So that's the GP or the issuer authorization at that point for them to go trade. Typically, we're stripping out a lot of those restrictions that are traditionally baked into those operating agreements or limited partnership agreements. There's very standard language in many templates that say, the GP has a right to deny or will request an opinion of counsel from the individual investor before allowing any tokens or shares to trade. And with tokenization, it's really beneficial to strip those out from the onset, and to make that a much more smooth transition once the tokens are able to be traded on a secondary market.
Okay, so legal that. Go ahead, Laura.
No, sorry, I didn't mean to jump in. Go ahead.
I was going to say, so it's absolutely critical that at different junctures, you mentioned lockout period on a Reg D, for example, that you need the advice of that lawyer. It's not, and I think this is where some of the nebulous viewpoints come in from the public at large, where they go, hey, I've tokenized this and I can immediately do something with it. But there's a lot of other factors that come into play, one from a legal perspective, as well as what the intent of the original issuer was. So it's not as easy as just saying, I think, a lot of people cross over or muddy the waters when it comes to, oh, the ICO world or an NFT world. Oh, I bought this, and I just go out there and do that. We're talking about securities here. So if we're talking about securities here, and I'm going to go into, I'm a real estate developer. I'm going to touch on you, Laura, on this one. So I'm a real estate developer, or I have an existing real estate property, and I want to basically securitize it in essence. I want to turn it into security, fractionalize that, because part of this conversation is fractionalization. What's my jumping off point? Do I choose the regulation? Do I choose my valuation?
Yeah, I just wanted to kind of follow up on what we were talking about, and this is, to this question as well, is that the idea behind the option of liquidity, right? If I can raise an unlimited amount of capital under a Reg D, and I raise, I don't know, $100 million, right, from 10 investors that put $10 million into my offering, right? And how much liquidity am I going to be able to give them on the back end, right? If one of those investors decides to trade out of their $10 million and they go to an ATS and they trade and they bring in another, I don't know, 1,500, 1,800 new investors onto the cap table, how much liquidity do those other investors have that brought in the $10 million, right? You really don't have that, the unlimited number, right, for them to actually have the option of liquidity. You can only have 2,000 on your table, right? Isn't that kind of where you were going with that?
Yeah. So where does that limitation come in? And maybe, at least being aware of where the regulations fall in, and maybe Tyler and Richard, you can chime in on that. So if I just look at the pure math of it, eventually, if I'm limited to 2,000 before I'm fully reporting, or can I restructure it down the road, but at least be aware of it up front?
Right.
Yeah, and that regulation, I can jump in on that. That regulation comes in under the Exchange Act, Rule 12G, and right, it is a limitation. Unless you want to become a reporting company, the rule is if you have more than 2,000 investors and 10 million in assets, then you're going to have to become a reporting company. And so companies have to make that decision very, very early on when they're deciding on their metrics. What is my minimum investment amount? How many investors am I going to accept? All of those decisions are very important at an early stage. And that's really a Reg D consideration that you need to address at the outset.
So no, I think that's a really salient point. And I think historically, when I talk to clients, when it comes to things like Reg D, the comments are, oh, I'm never going to have 2,000 shareholders. Well, it kind of defeats the purpose if you're going to tokenize an asset and they're going to break it down to pieces and you're going to break it down to pieces. I think it just merits, a big consideration up front. There's significant benefits for a Reg D if you have an accredited investor pool. But if you're just going to do marketing to the accredited investor and have no market awareness, which is kind of the next segment we're going to talk about, you may want to look at some alternative regulations from the onset, perhaps. And when I look at something more sophisticated like a Reg A plus offering, I may be limited for my 12 months on that Reg A to $75 million, but I can have unlimited accredited, non-accredited investors. So, Richard, what are your thoughts on that as a broker dealer? Are we starting to see a little bit more of companies starting to go, let's take a look at the Reg A because of the variety of liquidity options that it affords, ATS and others?
Yeah, I think the Reg A is a much more interesting space because of the greater number of shareholders you can have. You can have as many retail investors as you like. You can still raise up to 75 million in a year, which is a good amount. And there's no holding period, so there's a lot of pluses for that Reg A plus. The downside is, or the flip side of that is that it's more expensive. You need to pay excellent lawyers like Tyler to get yourself qualified with the SEC, and it can take something like 6 months or so to do it. But if you have a product that you think is going to have broader reach, and you think you can access, and not to mention that you need to have a marketing campaign around it. But if you think you have that type of product or that type of platform, then that's definitely something you should consider, and it's something we're seeing a lot more of in conjunction with view, Peter, at KoreConnex?
Yeah, we're seeing a lot of companies in the real estate taking advantage of a Reg A. It's as simple as that. They're looking at the Reg A, and they may be. And I remind me to touch. I want to touch on like series LLCs, for example, even on the real estate side of the equation. But they're taking advantage of. But one of the comments that I just want to make to the audience is there's a lot of moving parts here. And very often we get approached from, we're the technology kind of linchpin, where we're the hub and spoke, where we have to connect and engage with the broker dealers, engage with the lawyers, engage with escrow providers, engage with the SEC, engage with the payment rails. So we get a high level, broad understanding. But one of the things that we find that many issuers start to miss is who's going to manage all this. So internally, they have to take these considerations. And I bring that up because, Laura, you kind of quarterback a lot of these things right now. And what's some of the conversations that you're having when it comes to that? So let's say I want to do a Reg A offering. I mentioned a number of the intermediaries associated with that. Where does a quarterback come in to assist an issuer, for example?
Yeah, I mean, we're seeing a huge need in the space right now for those that don't really know where to start or how to get through that process. And, we start with, just going through budget, right? What's this going to cost? What does the budget look like? And we'll run a line item budget for the client, and we'll have the conversation of what type of, what's the long-term goal? What is the plan for the company? What type of investors are you targeting, et cetera? And we'll try to figure out what makes sense, partner them with the right attorneys, right? Bull Blockchain is an excellent attorney, an excellent firm as well. And we walk them, we kind of partner them with them. We'll have the conversations. We'll be there to help guide and assist. There's many partners that are involved in a security token offering, especially if they're raising capital for real estate. So there's the technology, right? KoreConnex has this amazing platform that will help manage the cap table. They'll help automate a lot of the processes, automate distributions and the communications with investors. We talk about why it's important to work with the right marketing firm, right? We're not marketing real estate. We're marketing securities. We're talking about, jurisdictional compliance and those kinds of things, custodial compliance. So there's all these pieces of the puzzle that need to be put together, and we try to make sure that the client understands that this is a marathon. It's not a sprint, right? Yes, we want to raise capital and we want to do that quickly, but we have to do it compliantly. And here's how we're going to do it, and we walk them through step by step.
No, I think you hit on a lot of points there. So it really takes a team. I mean, again, you mentioned the lawyer, you mentioned, from a preparation. And from that standpoint, Tyler, what's been your experience with, if a company jumps off on the wrong foot and says, oh, I thought coulda, shoulda, woulda, I decided to do this regulation, but I didn't think that the fact that, okay, I did my filing and it cost me, $50,000 to $75,000 in a Reg A, was that a fair assessment? But I didn't consider that it's going to cost me X amount of dollars in marketing, for example. What are your takeaways? You get clients coming back to you. You're the lawyer. You're the guy that's saying that it's starting that journey and saying, why didn't you tell me that there's all these other moving parts? Or is it just, hey, I did the legal filing and that's it?
No, I think it's an excellent point, Peter, because we do act a bit as gatekeepers in that respect. In that there's no benefit to sending a client through that process and getting halfway down the road and realizing there's all kinds of unexpecteds forthcoming. And so what we do in the early stages of the process is really work to identify those hurdles and then to define how we're going to address them and to make sure that the regulatory path chosen is the one that makes the most sense. And even with tokenization, there is a half measure that we sometimes recommend to clients. You don't need to tokenize immediately. Obviously, you have 12 months until if we're talking about a Reg D offering, you have 12 months until that lockup is going to expire. And so you have an opportunity to leave the door open for tokenization in your documents while not necessarily tokenizing at the outset. And so maybe 12 months down the road or 6 months down the road, you decide we definitely do want to tokenize. Our investors have appetite. They're looking for liquidity. The raise went really well. and now we're positioned for tokenization. And so that's an option as well that we talk through with clients. And I just want to say, I think, this can sound a bit daunting, but at least from a legal perspective, much of what we're talking about are exercises that we go through with clients, whether it's a traditional raise or a digital security raise. So it's not necessarily to say that it's going to be so much extra legal work. It's just there's an added stress on the regulations that affect the liquidity of the investor base.
Thank you for that. So I'm going through this journey. I've got my lawyer. I'm doing a Reg A offering. We see a lot of different structure. Like I may see a company in the real estate space that's saying, we're acquiring assets. So at the highest level, the company's going, and we're going to pay dividends. So from Core's perspective, we're managing the cap tail, managing the shareholders, but everything's digitized right from the onset. If a company wants to have a liquidation event, and what I'm referring back to there is a company might be a company that says, I'm going to buy real estate in the sector, we're going to manage the properties. Once we manage those properties, we're going to pay dividends. So there's an example of somebody saying, I'm going to do a Reg A offering, and the purpose of we want to attract investors that are interested in the dividend payouts. But further down the road, a company like that might say, hey, we want to have a large liquidity event. And I want to, what are my options? What do I want to do? We want to sell off the assets. We don't want to sell the company, or we want greater flexibility, or I want the shareholders the ability to at least liquidate their assets, even if we have performance dividend payouts. And I want to go to an ATS. So to you, Richard, because we get a lot of accounts like this right now. And I'm going, okay, they're already, as far as we're concerned, they're already on a blockchain. I mean, in essence, these securities are tokenized. It's just a matter of moving them to an ATS. What's that process look like, Richard? Company says, now I want secondary trading.
Well, if they're already working with you, Peter, at CoreConnex, and we already have an integration, it's going to be very straightforward.
I set everybody up on that one a little bit because it's early in the game. It's still early and nascent in the game when it comes to secondary trading. But from your perspective, I mean, we hand it off, so to speak. Technology hands off part A to part B, and part B happens to be an ATS. And but what does that look like? What is the issue we have to go through? Okay, I want to do this. And what are the downsides and what are the expectations that are realistic?
Yeah, well, they need a couple things. They've already issued, and then later down the road, they want to tokenize perhaps after the 1 year holding period. They need a couple things. They need to work with a partner who will help them issue the tokens. And maybe they'll work with, Laura gives them advice on what blockchain to use or what partners to work with. And they'll definitely need a transfer agent as well. CoreConnex is a transfer agent, and they do both of those functions. In fact, that's the main things that they need to do. We can work with them as well and kind of guide them through the process. Essentially, the transfer agent will look to kind of, if they didn't have one already, take that cap table and put it into kind of blockchain format. We would need to integrate with the transfer agent from our point of view. So, for example, we need to make sure that if somebody wants to sell a trade, what we do is we open an account for them first of all. All the buyers and sellers need to have accounts with Texas Capital, so we need to do KYC, etc. But once they enter, if a seller enters a trade order, what we'll do then, we'll read the blockchain via the integration that we have to make sure they have the share they want to sell, and then that's entered into the ATS. If there's a match, what we do then is we communicate to the transfer agent and the cash custodians to make sure that the securities and the tokens are moved after, and the cash is moved after the trade.
Okay, and at the end of the day, the cap table is updated with the new shareholders associated with that trade, and the trades are all done in real time. I've got a question here that from the audience here, and you just throw that at the panel here. I assume the discussion of tokenization, you include all aspects of smart contracts. What terms or conditions cannot be included in such a smart contract? Question's a little bit how long is a piece of string, I think, but does anyone want to jump in that? Tyler?
Yeah, so the smart contract in this context is mainly going to govern who can purchase the token, and so you might have jurisdictional restrictions, you might have accreditation restrictions, and so in the securities context, those are primarily the terms that are going to be baked into the smart contract restrictions. In other contexts, there's lots you can do with smart contracts. Lots that you can do with NFTs and IP rights and licensing and things like that. And so that opens up a bit of a can of worms that's kind of separate from the talk today. But it's certainly a good question because smart contracts are so flexible and diverse.
Okay, thanks for that. Again, it comes back down to the term tokenization has a variety of meanings. I mean, at the end of the day, from a securities perspective, we have a smart contract that's tied to a security versus other types of immutable ledgers that are smart contracts between a variety of parties. Something that came up yesterday that, I mean, if we had a crystal ball, we're looking into the future because it involves a lot of jurisdictions when it comes to land titles. The one thing I think that a lot of people need to realize is that there's a big friction point today when it comes to, I've got an existing real estate asset, I want to tokenize that asset, and I don't want to get in the securities world. I know that Germany is doing some interesting things in the tokenization space for that purpose. But how do we, what do you foresee in the future? Like does land titles, or is it too bureaucratic in the near future, get tokenized / digitized / smart contracts orientated? Any thoughts in this regard?
I mean, I hope so, right? I think, in the US, there's 3,033 counties and they all do things different. So I think that has to be streamlined first. And we need to figure out how we can all kind of get on the same page with how that happens. And then we can, move into mass adoption on tokenizing and transferring product through tokenization, NFTs, et cetera. But right now it is a very long road, I think, for that in this country anyway.
So I tend to agree with that. And I think it's really important for the audience to say, if there's these significant friction points today, I mean, things evolve, things change, and all of a sudden there can be a major pendulum shift. But it sounds like taking a look at the regulations that exist today, such as, I'm a fan of Reg A because it's probably the most flexible, open regulation that existed. Tyler's probably a fan of it because it's the most, because it's a sophisticated offering and it certain benefits the legal community, but it does benefit the issuer if they go into it with an open mind and really understand what's involved with that. It sounds like that's, if you want to tokenize real estate, take a hard look at a Reg A plus offering. But I'm not here, I have no benefits from that perspective other than just to say, or get your guys' thoughts on that.
Yeah, I think, can we dig in a bit more on the series LLCs? Because I think that's an important part of the fractionalization. And I know we've only got a few minutes left here.
Yes.
That's, just to say we're seeing a lot of that right now. And what a series LLC is essentially, it's a legal structure where, for example, in the real estate space, a real estate sponsor could offer many different assets, many different properties under the same kind of Reg A filing. And then, so each of these, they're individual LLCs, each LLC can be tokenized. And what we're seeing a lot of is folks in the real estate space creating marketplaces where investors can come in, retail investors, because it's a Reg A offering, and pick and choose, I'm going to put, $1,000 into, 123 Main Street, and maybe $550 into, 424 High Street or something like that, and be able to build their portfolio of real estate assets on a fractionalized basis. They can get exposure to different types of properties, different locations. And we're seeing lots of very interesting structures there as well. Like you can have multifamily or commercial or home equity investments, the exciting project we're working on right now. So we think that's a big growth area. And that's something we're partnering with you guys on.
We're seeing a lot of that. And I don't know if Laura, you're seeing a lot of a lot of companies that are in the real estate space, but it's not just the large project to say, hey, I'm going to do, I have a $300 million project. It's smaller companies saying, hey, I'm an expert in residential real estate, and I am going to do a series LLC and do asset acquisition in multiple properties and allow participation from multiple individuals with small pieces that really couldn't participate before. And that's the most wonderful thing I love about not just the series LLC, but the Reg A in general. I mean, individuals, I think, are going to start to say to the investment community, you have the ability to your kids, for example, to say, hey, you want to own a small piece of a house? You have that ability to start that journey and build up your own portfolio. So yeah, thanks for that, Richard, because the series LLC, we're seeing a lot of that in a variety of different categories. And that's where the Reg A Plus, it really, really affords a lot of different opportunities. Laura, are you get more inquiries in that regard?
Yeah, definitely. I mean, we're doing a lot of education on that right now. As you know, the majority of the offerings that are being done in real estate are under Reg D. So, we start talking about other options, and it's a process trying to educate, but there's a lot of interest around it when they realize, what the potential is. And I really truly believe that there is going to come time soon when investors start to figure out what their options are, that they're going to ask the owner, the issuer, is this tokenized? Do I have the option of liquidity if I invest in your real estate project? And that's going to be something that is going to be really important to be able to say yes to.
No, I think it's an excellent point. I think we're getting into our final minute here. Any final takeaways from the panel here? I think it's been insightful, and I want to just make a comment that all of the information on each panel member here, from Richard to Laura to Tyler, is posted on the website, and should feel free to reach out to them individually should you guys have any questions. Anything else? Closing comments?
I just want to say thank you for, everything that CoreConnex is doing, always educating, leading the space, always trying to, enforce and make aware how important compliance and regulation and all of those things are. So I really do appreciate what you guys are doing. So thank you for that.
Thank you very much. Appreciate it. Education's key. It's still early. Was that Richard there?
I was just here. I said.
No, I appreciate it. Is education. Look, it's some people said, where are these regulations at? Where's ATS is? Where are the legal changes? Where's the regulation changes? What's going on in the future? And I thought we were on first base, and a lot of people still believe the stadium's just being built. So there's a lot of opportunities for the future. I think, again, education is absolutely key. Closing out, I see a comment here, and it's, I thought blockchain was supposed to be a trustless, but now we have intermediaries. We live in a world of regulations, and we live in a world in compliance today. Whether we like it or not, we only complain about the regulations when they appear to get in our way. But then we ask for the regulations when I'm unregulated, and I may have unfortunately been taken advantage of. So, I mean, there's two sides to the coin, and I think the future holds well for the regulations. Hey, I'd like to have no regulations and the entire planet is all trustworthy, but unfortunately, we don't live in that world. So, again, thank you to our panel. And now we're going to jump into the next session for those that are with me, and to say, okay, I've done the regulations. I understand the regulations. I've got my team put together to move forward. And now I've got a little bit of heavy lifting. It's called the marketing side of it. So for those of us watching right now, I invite you to join us for the next session. And again, thank you all. I really, really appreciate the time.
Thank you.
Thank you.
Thank you.